Okay, well, thanks very much. As you can see on the screen, everyone, now that you can hear me and have got the correct screen showing, the title of the lesson is Low Risk, High Reward Currency Trading. More specifically, what I want to achieve today is to show you why currency trading is probably one of the best opportunities for amateur traders or investors to really gain financial independence and freedom. So whether you're hoping to quit your job and earn a full-time living from trading, or if you're trying to provide yourself with a comfortable retirement, ultimately we all want the same thing, and that is to not have to answer to anyone else. You want to live life on your terms, make your own schedule, work less and earn more, and have enough money to be able to afford life's luxury. So in other words, you want financial freedom and you want lifestyle freedom. And I think that currency markets offer probably the most attainable route to achieving all of that for amateur traders. And before we go any further, let me just alleviate any of your concerns. If you do have them, I'm not going to try and sell you anything at the end of the presentation. Instead, what I'm going to do is give you a trading package that I usually sell for $300. I'm going to give you that for free, and I'll actually make a wager with you. So I'll show you how to make money in less than 1 hour a day. And if that doesn't work for you over the next month based on what I show you in this presentation, then I'll actually just pay you $10. If it does work, you pay me $10. So we'll have a straight up $10 wager. And I think that's a pretty fair offer. You can't actually lose if you think about it. And hopefully it shows how confident I am in what I'm going to be showing you today and that it will work. I think there's a couple of hundred people on here. So it would be very expensive for me if I had to pay out on that wager to everyone. And yes, it will apply to anyone that's watching the recording as well. So hopefully that's got your attention, and it'll motivate you to stay with me and see what I've got to say over the next 50 minutes or so. First things first, I know you've seen the disclaimer already. I'm going to show you my own. It's not just a legal obligation that I begrudgingly flash up on the screen. It is extremely important. Trading can offer you absolutely massive rewards, but it can be incredibly risky, especially if you don't pay attention and you do things wrong. So everything I show you is for informal education based on my personal experience and opinion. So it's not professional trading advice or investment advice. And if you choose to participate in the currency markets, you are doing that at your own risk, and you are responsible for your own decisions. Now, by all means, listen to what I have to say, and I really hope you do. But just remember that I'm a stranger on the internet that you've never met. So if you are going to take any actions, it should be because you trust yourself and you're satisfied that you have enough information and the ability to make informed decisions for yourself. So what I'm basically saying is please just be an adult about this and take responsibility for yourself. And so that I'm not quite so much of a stranger, let me just introduce myself very quickly. I am the founder and the owner of CompleteCurrencyTrader.com, which is a website that provides tools and education for forex traders, and we've been doing that since 2012. And I don't want to bore you with my life story, but I've been trading full-time since 2006. So that's 12 years that I've actually been making a living from forex trading, and it was luck rather than judgment that got me into this. I'm a former Royal Marine, and then I was a bodyguard, and whilst I was bodyguarding a billionaire commodities trader or former commodities trader, I had a chance encounter with John Henry, who was a currency trader. Now, he has shut down his hedge fund now, but at the time I met him, his fund had about $2.5 billion under management. And that was my first introduction to the forex market. And I've never looked back since then. And the connections that I made back then meant that I was able, and fortunate enough, to get my education and advice from hedge fund managers, as well as the head of forex at one of the top 10 world banks. So bodyguarding some of the richest people in the world meant that I was able to learn this profession from them as well. So it was serendipity playing a huge role in my start as a forex trader. I can't take all the credit, but nevertheless, it meant that I've learned to do this properly from the start. And that's resulted in me becoming a millionaire relatively quickly whilst I was still in my 30s. So that's my story. Now let's look at how I can help you and what we're going to cover today. We're going to start with why forex is, in my opinion, the best financial market for amateur traders to use for their own independent wealth creation. If you're interested in trading, you've obviously got a lot of choices with lots of different markets. So I'd like to give you a comparison for why I think this is the best option for you, especially if you're trying to do this on a part-time basis. I'll show you some unique and rarely known characteristics that make currency markets very different to some of the more traditional markets, and how this makes it so much more advantageous and actually easier to exploit. And with that in mind, I'll show you some tools and strategies that will enable you to turn mediocre results like these and turn them into this. And that is exactly the same system, by the way. It's the same results or the same rules of the stop loss and profit target, money management, etc. We just made one slightly different criteria change that's only possible in the currency markets. You couldn't do what we've done here in any other market. And I'll go through the stats on this later, but just looking at that equity curve there, which set of results would you rather? Bearing in mind, they both involve exactly the same amount of work. I'm assuming you said the one on the right-hand side. It's a no-brainer, isn't it? Well, I'll show you how this can be achieved during this presentation. It is a pretty effective license to make profits, and you can successfully do that in less than 1 hour a day. And then to finish with, hopefully we've got enough time, we'll do a 10-minute Q&A, and with any luck, we can jump into some live markets, have a look what's actually going on right now, and talk about what I've shown you in the presentation and actually apply it to the live markets. Okay, so let's start by looking at some of the advantages that I think make Forex the best market for amateur traders to create financial independence for themselves. Well, first of all, it's the size. It is absolutely huge. It is the biggest and the most liquid market in the world. It's got $5.1 trillion average daily turnover. So that's over 1,300 trillion annually, which, as you can see, just dwarfs every other market. And a market of that size naturally and inevitably presents far more opportunities for us. But best of all, only 18% of the Forex market is speculative, meaning that the vast majority is utilitarian in nature. Now, speculators are your competitors. They're the people that are trying to make a profit. So you're up against them. Utilitarian traders are not. So proportionally, Forex is actually less competitive than other markets. So it's a very, very big pie that we can more easily take a share of. It's open 24 hours a day, 5 days of the week, so you can trade it during your morning, during a lunch break if you're working, or in the evening, or whatever suits you and works around your current schedule. And that makes it far more convenient and flexible to suit you, which makes it a perfect option if you are doing this on a part-time basis or you are trying to fit it in around an already busy schedule. It's also accessible to anyone because you can open an account in Forex with as little as $100. You don't already have to be fairly wealthy to get started like you do in many other markets. You don't need a lot of disposable cash. And there's also a high degree of leverage available, which means you can manage smaller accounts to produce bigger returns. Now, I know that leverage can be a double-edged sword if you're not careful, but it is a massive benefit if you use it correctly and safely. You can get 50 to 1 leverage in the US. You can get up to 400 to 1 everywhere else in the world, which effectively allows your money to work 50 to 400 times harder for you. And relatively speaking, it's a safer market because of its size and its high levels of liquidity. You can usually get in and out of trades instantly and easily, even with orders of several million. So you're unlikely to get stuck in a trade that you can't exit, which is something that happens all the time in other markets. And because of that high liquidity, the transaction costs in the forms of spreads and commissions are extremely small. My broker, for example, charges me just $50 for every $1 million that I trade. So that's 50 cents per $10,000 contract. Now, try finding that in anything that low in other markets like stocks or options. It's such a cost-effective market to be trading. And I could go on and on with lots of other benefits, but I think you get the main point. This is an extremely attractive market from all sorts of different perspectives. And if you are serious about making money and generating wealth for yourself, you won't find any other market in the world with quite as many favorable conditions as currencies. Now, if you trade, and it doesn't matter what market or instrument, stocks, currencies, anything else, what do you trade? What do you actually look at? And it doesn't matter whether you do technical analysis or fundamental analysis, but the instrument or asset that you're trading is represented on a price chart, right? We've all got to use those charts because ultimately that is the thing that tells you the actual price. This is where you enter and exit your positions for profits or losses. And all charts in all markets look the same. You couldn't tell me which of these is an oil chart, which is a Google stock chart, or which one is the Euro US dollar Forex pair. And this is the reason that most traders trade all markets in fundamentally the same way with the same techniques, using the same tools and the same indicators and the same systems. But anyone trading the Forex market using charts is making a mistake. Forex is the best and the easiest market in the world to trade if you do it correctly, but it is worse than a dodgy casino if you try to trade it the same way that you would trade other markets. And that's the point I'm making here. We're talking about a very unique market, and what I'm showing you here applies exclusively to this market, not other markets. Unlike other markets where the underlying instrument being traded is an asset by itself, Forex is not an asset. Currency pairs are not assets. Forex is an amalgamation of multiple different markets all brought together under one roof. Just about every currency in the world is obviously included there, but there are 8 major currencies that are considered the dominant ones based on the volume of trading that's done on them and their liquidity and transaction costs associated with them. And that's actually another advantage of Forex over stocks that I didn't mention earlier. There are really only 8 choices. Stock trading can be quite overwhelming because you sit down and there are literally thousands of stocks to scroll through and choose from. And how do you choose from such a massive selection? But with Forex, there are really only 8 currencies to look at. So it is far simpler. And those 8 currencies can be combined to give you 28 different pair charts. So if you match the US dollar with the British pound, that's one pair. If you match the US dollar with the Japanese yen, that's another pair, and so on. But a pair or a chart is not a thing as such. It's not an asset. It's not like gold or oil or a company stock. Each currency is a thing that belongs to a different sovereign nation, and they all have different economies. They've all got different interest rates, different levels of inflation, different central bank policies and geopolitical conditions, etc. It's the individual currency that's the unique standalone market. The euro market is separate and very different to the US market, and the euro US dollar chart is simply telling us the exchange rate if you traded one for the other, if you actually exchanged them one for the other. Currency pair charts are the same as if we could match gold against oil. So gold is one market, oil is another market, and a gold oil chart, if such a thing existed, would be telling you the exchange rate if you wanted to swap 1 unit of gold for the equivalent units of oil. If you were going to try and trade or predict where the price of that fictional gold oil chart was going to go next, would you look at that chart, or would you think it was a little bit more sensible to look at the gold market first in isolation, then the oil market, and see which one is going up and which one is going down? If the gold market was going up because the price of gold was increasing and the oil market was going down because the oil price was falling, which direction do you think the gold oil exchange rate would be going in? Can you see how that makes sense? Yes? You'd rather buy the rising commodity and sell the falling commodity, and then you'd know exactly which direction to trade the exchange rate. So when you trade the euro US dollar, what you should do is look at the euro market first, then the US dollar market, and see which one is going up and which one is going down. And that way, you've got a better idea of where the actual exchange rate on the pair chart is likely to go next. And that's the most important factor that makes Forex so profitable. Let me just give you an example. This is the General Electric share price over a 12-month period, and this is Microsoft over the same period. Now imagine if you could combine them onto one chart and trade them against each other. If the strong stock has gone up in value by 40% and the weak stock has lost 50% of its value, when you put them together on the same chart, the net effect would be multiplied, and that chart would actually see a much more significant change of 90%. So there's a heck of a lot more money to be made there, isn't there? Well, unfortunately, you can't do that in stocks, but we can do it in Forex. The secret and the advantage that is unique to Forex is that we can look at individual currencies and then trade the best ones against the worst ones for that exaggerated price move and therefore exaggerated profits. Anyone who's ever traded anything knows that trending markets are where we make the biggest profits and the easiest profits. And as the saying goes, even a monkey can make money in trending markets. It's that easy. But how do you know where the trends are going to be? Well, in Forex, you look at the individual currencies and you find a strong currency in an uptrend and a weak currency in a downtrend. And then you go to that pair chart, matching them against each other, and you ride the absolute best trend in the market for the biggest profits. Can you see how powerful that is? And that's only the start. Not only can you find the very best trades that will make you the most money, but you can also identify the really bad trades that you should just avoid at all costs because they're going to be giving you the losses. When you look at the whole market, and don't worry, I'm going to show you exactly how to do this in a minute and give you a tool to do it. You can see a strong currency and a weak one, and you know that that pair is going to be trending like it's on steroids. But you can also see a flat currency and another flat sideways currency, and you instantly know that that pair is going to be going nowhere, and you can stay away from it and you can avoid any choppy unnecessary losses. The same thing would actually be true if you tried to match a strong currency against another strong currency or two weak currencies. Those two similar currencies would actually cancel each other out and the pair chart would be going nowhere. So can you see the difference here? Can you see what separates profitable currency traders who seem to find it very easy compared to most people who seem to really struggle so much and never actually achieve any success? Traders who trade pair charts in the currency markets are more or less trading blind. They'd have much more success if they bought a lottery ticket. Remember that with 8 major currencies, there are 28 different pair combinations. So one single pair chart is only 1/28th of the market, or just 3.5%. So of course you're not going to be very successful and you're going to struggle if you're trying to trade a market and you're only using 3.5% of the available information. That is next to impossible. But a professional trader looking at the whole market, the real market, has 100% of the information available to them. So they are looking at least 28 times more information than an amateur looking at a chart. So that's like having a 2,800% greater edge. So of course trading is going to be easier for that trader. Traders who know about this have an unfair advantage over everyone else. So now let me show you how to actually exploit this in the market. You need to be able to isolate the individual currencies, and for that we use this market analysis software. What this is really a big suite of advanced tools, multiple different tools that tell you exactly what's happening behind the scenes with each separate individual currency. And you are going to be able to get this for free at the end of this webinar if you stay with me. If we start with just a very basic level, in the lower half of that dashboard, we've basically taken all of the individual currencies, just like I was showing you in that previous slide, and we've overlaid them on top of each other. So at a glance, you can compare them all instantly and see which ones are strong or weak versus all of the others. And we can do that for 3 different time frames, as you can see in these 3 different boxes. You may have some previous experience of doing top-down analysis or multi-time frame analysis. So we check the longer term, we can then check the medium term and the short-term trends. Well, we can do that by looking at this at any customized time period we want. You can look at minutes to seconds, all the way up to months and years. And one particularly useful benefit of this is we can look at a specific session. The market as a whole, forex, is open 24 hours a day during the week, but it is still broken down into different financial centers such as Tokyo, London, and then New York. And one of the most effective things that we can do is to follow the institutional sentiment for that particular session. Now, banks account for the vast majority of all the volume in forex. So let's take the New York market as an example. The banks have got huge trading floors. They've got hundreds of traders working in teams, and they will often have a common agenda, and they're going to be extremely active and concentrated on specific currencies or pairs during their working day. They're not just trading every single pair all at once. They do tend to concentrate their collective efforts as part of a daily objective for the bank. And we can set this to look specifically at the New York session. We can ignore everything else. So if you're trading during the New York afternoon when only New York banks are open, it would be wise to do what the New York banks are doing. So what if the longer term trend is on something like perhaps the euro against the Australian dollar? Doesn't matter. If today the New York banks are ignoring the euro Australian dollar, and instead they're heavily trading the pound yen, guess where you'd want to be and where you're going to make the most money? That is an invaluable aspect of this software because it means you can track exactly what the big banks are doing right now today and follow their lead in real time. And that's just the tip of the iceberg. I don't want to overload you with a complex lesson on this software because there is an awful lot to it, and I'll actually give you a full training course at the end of the webinar as part of that $10 wager that I mentioned earlier. For now, let me just skim over it quickly and give you a very brief overview, and then I'll show you some actual trading strategies with this. So we've got that multi-time frame strength and weakness analysis in the lower part of the dashboard, but above that, we've got a whole host of extra information that lets us see behind the curtain at what the banks are really doing. We can see the individual currencies and which ones have the biggest range of pip movement, and that's different to simple strength and weakness. This shows us the actual pips or the price points that a currency is moving. The bigger the move, the more money that we can make. So in other words, it helps us locate the active currencies and avoid the quieter currencies. We can also see the tick volume for each individual currency. Now, this aspect of volume in the forex market is a little bit different compared to other markets. Because it's an over-the-counter market without a single exchange, it's quite difficult to actually see the full order book, which means we can't know for sure all of the size of the orders that are being transacted at each level. But we do have this tick volume, and it tells us when an order hits the market, and we can see how many orders, but we can't always necessarily see their size, and that's what tick volume is, and it is extremely useful. Currencies with more volume are more active and have a higher number of orders being executed on them. And I'm going to come back to what the red and green bars on this are in just a moment. First of all, we can also see the levels of liquidity that are being provided on each individual currencies. And again, more liquidity is way better than less liquidity. So with the pips, ticks, and the liquidity sections that we've just seen there in the middle, we are looking at the size of the columns, plus whether or not the right-hand column is bigger than one or both of the other currencies in their group. When we're looking at liquidity, we can actually see the levels of liquidity also across the entire market, not just the individual currencies. So some days liquidity drops off and we get really quiet markets, which should ideally be avoided. Other days, the liquidity really skyrockets and we get some of the best opportunities to profit. And we can see that in real time at a glance with this window. And just like the session strength and the weakness section, this liquidity feature can be set to look at a specific market session, compare today against the average for this session. So that way you can see if today's New York session, for example, is better than the average New York session. And that by itself is one of the most effective filters you can ever use. That is one of the best things that I use in my own trading. It helps get me into more winning trades, and crucially, it helps me stay out of losing trades. Even if it looks like something good might be happening, I can look at the liquidity and realize this is going to be a low probability market and I can avoid it, and it keeps me out of so many losses. You can also see the individual currencies just separated. You can compare them against their own moving average, and you can isolate one or as many of the currencies as you like if you want to filter out some of the market noise and just analyze certain groups in isolation. So it's a really versatile interface, and as I said, I'll give you some advanced training lessons teaching you to use this as part of that bonus package you'll get for attending MarketFest today. But behind that main interface, we also have a ticks details tab. Now, this shows you the breakdown of the tick volume for every currency and every pair. Now remember, tick volume in Forex tells you the number of orders. Very quickly, you can see which pair is attracting the most order volume this session and trade the pairs with the highest volume and avoid the pairs with the lowest volume. But additionally, you can look at the individual currency group and you can see where most of the order volume is happening for that currency. For example, let's say that we can see on the strength chart that the Canadian dollar is the overall and very obvious best currency. But what do you pair it with? Well, there may be several options. Well, you come in here, you look at the Canadian dollar group, and you can instantly see that 25% of the order activity on the Canadian dollar on this particular day was happening with the euro. So that's 2.5 times what we see against something like the New Zealand dollar or even the US dollar. So if we wanted to trade the Canadian dollar that day, the best option was against the euro. Why? Because that's where the majority of the activity is. This is where most of the Canadian dollar orders are being concentrated, and banks are responsible for the majority of orders. So this is where the banks are concentrated, and we obviously want to follow what the banks are doing. And one other thing that you can look at on this is the correlation value. So a positive correlation means the two currencies have been doing the same thing for most of the time. So here we've got the euro and the Swiss franc, for example, have been doing the same thing 90% of the time. When one goes down, the other goes down as well. And the pair itself, because of that, is likely to have been in a tight, narrow range. Whereas the euro and the Canadian dollar have a negative correlation, which means the two currencies have been doing the opposite to each other most of the time. So here the value is negative 94, which means 94% of the time they've been moving in opposite directions. When one goes up, the other goes down, and the pair chart, unsurprisingly, is likely to be in a great trend. And in these examples, we've got a 180 pip trend versus a 20 pip range. Can you see how much easier it is to make money with all of this information at your disposal? You can really zoom in on what you're doing. And it actually changes from one day to the next. So while amateur traders tend to just pick their favorite pair and stick to it every day, with this, we can actually follow the best moves as they happen, and that will change from day to day. And the whole software is a bit like a game of top trumps. You go through that checklist. Strong currency is going to beat a flat currency. Big pip ranges beat small pip ranges. High liquidity beats low liquidity. High volumes beat low volumes. High order concentrations beat lower concentrations. The negative correlations beat positive correlations. It doesn't matter what measurement we're looking at, we can always find the highest and the best values in the market. So you are always holding the very best cards when you trade with a tool like this. Now, just compare that to an amateur looking at a currency forex chart. It'd be funny if it wasn't so sad. A chart tells you virtually nothing in the currency markets, and any trader relying on them by themselves is floundering in the dark, to be honest. Whereas this tool enables you to identify where and how the big banks are trading, so you can follow their lead. Bank traders leave really big footprints, which are really easy to follow when you use a tool like this and know what to look at in the market. And actually, there are some more discrete clues that are even more powerful when you know what to look for. When we look at the tick volume here, we can actually break that down into the bids and the offers. And this is looking specifically at what market makers are doing. And that's what these red and green columns are showing. We can track every time a market maker improves their bid or improves their offer. So in other words, every time they submit a new, more competitive order into the market on either the buying side or the selling side, and that lets us see whether the market makers are trying to buy more or trying to sell more. With the green column, if it's bigger than the red, it means that market makers are trying to buy more than they're selling. And when the red column is bigger than the green, it means they're trying to sell more than they're buying. More often than not, the price is going to go in the same direction as the market maker activity all the time. However, occasionally there's a hidden pattern where the price is going one way and market makers are doing the opposite. And we actually have a separate indicator that runs off this dashboard that we can attach directly to a chart to see this. So on this chart, you can see that there is a solid uptrend in price. And if we look at the bid offer indicator underneath, it is mostly green, which means that market makers were predominantly following the market up. They are adding more and more competitive bids to the market. That's exactly what you'd expect to see. And you do see the majority of the time. Green in uptrends, red in downtrends. That by itself is extremely useful because it lets you know that you are trading in line with the order flow. That's an advantage that I use every single day with my own trading. But now and again, the price will move one way and the market makers are effectively trading against it and pushing in the other direction. So here, for example, the price is very definitely falling, but market makers were heavily buying into that move down. And that is effectively causing resistance. And it makes it very likely that that downward trend is going to stop. And if the market makers continue what they're doing on the opposite side, the price will actually reverse and go the other way, which is exactly what happened here. So that's a very reliable way of locating high probability turning points in the market. In fact, the strategy that I use to exploit this pattern has got an 88% win rate at the moment with a 1.4 to 1 reward to risk ratio. Now, when an amateur trader looks at a chart, they've got no idea if the trend is going to continue or reverse. But when you look at what market makers are doing behind the scenes, you've got a very accurate way of assessing the real situation. If market makers are in flow with the price, the trend is more likely to continue further. But if they're trading against the price, the trend is more likely to stop and reverse. So you've got two huge advantages to trading like this and using this kind of analysis. Not only do you know when to get into high probability trades that are likely to give you a profit, but you'll also know when to stay out and avoid them with much more likely losses. And staying out of bad trades, if you've done any trading yourself, you'll know is just as important as finding the good profitable trades. Most people kill themselves in their accounts because they trade too many losing trades. That's probably one of the biggest complaints that all traders have, certainly that I speak to. How do you know how to filter out what we call false signals or bad trades? How can you avoid those unnecessary losses? Well, don't enter a trade on a currency that's going sideways. Don't enter a trade if the market liquidity is very low or below average. Don't buy a currency that market makers are selling. Can you imagine what you'll be able to do with a suite of analysis tools like this? Well, let's just go back to that graph that I showed you at the start and we'll make a comparison. In this strategy, we traded the same pair every single day when this was the pound US dollar chart. And that's what most traders do. They just pick a pair that they like and they trade it every day. And all we did here was play a simple breakout strategy. At the market session open, we placed a bracket above and below the price. And if the price went up and it broke the top of that bracket, we bought. And if it went down and broke the bottom of that bracket, we entered a sell trade. And then we just had a trailing stop based on the average true range. We had a ratchet stop. Now, this is a back test, and let me just give you a word of warning. A back test is not an accurate portrayal of what real results would have been. They can't replicate live market conditions with widening spreads and slippage and partial fills, etc. Back testing is fantastic for proving the general principles of a strategy, but you should never rely on them to believe that live trading would produce the exact same results. And that's the reason you see those small print disclaimers about hypothetical results not being representative of real results. With that said, however, you can see that hypothetically, if you'd taken a simple breakout trade on the pound US dollar pair over the last 12 months, you could sensibly have expected to have produced a good profit, probably actually a better profit than most people have made in the past 12 months. This is a 33% profit where we were risking only 1% per trade. And what I like about this is it proves how simple trading can be. You don't have to have a complicated system or indicators as long as you keep things simple and consistent and you execute the same thing repeatedly. But look at the difference when you add individual currency analysis like I've shown you today. This is the exact same strategy in terms of the trade management, except this time we use the dashboard to follow the banks and only trade the best pairs. So one day we might have traded the euro US dollar, but the next day it might have been the pound yen, and the day after that it may have been the euro against the Canadian dollar, and so on. In other words, we used a breakout system, but we only did it on pairs that the banks were active on for that particular day. And of course, certain days we didn't take any trades at all because the overall market conditions just weren't good enough. Liquidity was particularly low, for example. Now look at the difference in the stats there for the win rate, the total profit, and the drawdown. Those are massive improvements on every single metric. And do you know the best thing? You can apply this kind of professional analysis to any system that you like. If you already have a system that you trust and you enjoy trading, then stick with it. Don't change that. But imagine how much more effective and profitable you'd be if you only traded that system on a pair that's got a strong currency and a weak currency, and you've got high liquidity that the banks are active on. Imagine, instead of just picking the same pair every single day and blindly hoping for the best, you actually take a look at what the banks are doing and you follow their lead. Do you think you'll have a better win rate? Do you think you might catch bigger trends? Do you think you'd be a more profitable trader? Are you seeing how simple and easily applied this is? It's not complicated at all. It is just common sense. As long as you have a system that has a positive expectancy, you can apply individual currency analysis and you will improve the expectancy of that system. This technique, this kind of analysis can dramatically improve and increase any other edge in existence. So this is the tipping point between, a little bit of profit, but general mediocrity, but really accelerating into that top tier of success with your profits. And it works for all market conditions. You know how some systems are perhaps over-optimized for a certain set of conditions. They work great some days, but they fail miserably on other days. And that's because most systems are designed after looking at charts. People look at a chart, they see what would have worked in the past, and then they design a system in the hope that the same thing happens in the future. But when the conditions change, which they always do, by the way, the system stops working. But that's not an issue with this because you are always looking at the real market today. So you will always be able to trade based on what is actually happening rather than what your system would like to happen. In other words, you're going to make your trades suit the market rather than hope the market suits your trades. And let me just give you a couple of different ways that I personally exploit this. So this is the way I trade. I've already shown you that one way where I look for the price moving in one direction, but market makers buying or selling in the opposite direction. So in other words, market makers resisting the price move. So here, the price was moving down in what appeared to be a nice downtrend, but all the way down, market makers were buying into it. And that sets up a very high probability of a reversal in the market. So there's basically a wall of resistance from market maker pressure, which is very likely to stall that price in its tracks. And as soon as that happened, I entered a buy and then I rode the market back up in the opposite direction. And on this trade, I had a take profit 3 times bigger than my risk. And as you can see on this occasion, the price actually went a lot further after I'd exited at that profit target. This is the strategy that I mentioned earlier. It currently gives me an 88% win rate with an average reward to risk ratio of 1.4, almost 1.5 to 1. Now, another strategy is to look for patterns that show when banks are initiating massive orders that act as a catalyst for fast-moving big trends. So here you can see that early on in the London session, just 8 minutes into the London session, the New Zealand dollar was moving up to strength significantly, and the US dollar was getting weaker in almost equal proportion. Now, those two currencies really stand out as very obvious and different to all the others, don't they? But not only that, look at the liquidity across the whole market. It was 119% higher than we usually see when London banks are trading, which means that the banks on that particular day were massively active, way more than normal. And if we look at the flow of market makers' bids and offers, they are submitting more buy orders than sell orders on the New Zealand dollar and more sell orders than buy orders on the US dollar, which is exactly in flow with the direction of price. Now, I can't fit every element of the dashboard onto this screen at this scale because it'd be invisible for you to see, or you wouldn't see the detail. But at the time of this trade, there was also a very high negative correlation over negative 90%, and the pips and ticks were also aligned. So what I'm basically doing is just going through a checklist of conditions. Like I said, it's like playing top trumps, but I can select the best values in every topic and stack them on top of each other. So what I did here was I entered a buy and I rode this up, and I eventually exited up here for a profit, again, almost 3 times bigger than my initial risk. That particular strategy gives me a 57% win rate, but it's got a much higher reward to risk ratio of 2.2 to 1. It's got a lower win rate than my other strategy because I manage it differently. Because with this one, I'm trying to actually capture those bigger moves. I'm less aggressive with the trailing stop, and I give a bit more of my profit back on this one in the hope of hitting the home run. Even so, though, on average, I win almost 6 out of every 10 trades, and my average profit is more than double the size of my average loss. And those are just 2 of the ways that I personally use the information for my own profit. But really, there's no end to the ways that this information can be presented and used and exploited. There's almost as many options as there are traders. You can scalp with it, you can swing trade with it, and you can long-term trend follow. You've all heard the expression that knowledge is power. Well, look at the knowledge that this opens up for you. And I want you to stop for a second and think about what this ability will do for you and your trading and how it differs from other markets. Imagine the confidence that you'll have knowing that you can spot the best trends and you can avoid all those choppy ranges and actually follow the lead that the bank set. Just picture yourself trading with this. This is what professionals do when they trade. It's what gives us our advantage over everyone else, and it makes life as a trader far more profitable, far more enjoyable, and far more reliable. Your win rate will go up virtually instantly because you are stacking the odds in your favor. As I said, you just go through that checklist of adding one thing on top of the other. So just imagine, what it'll be like to enter every trade knowing that it genuinely has a higher probability of winning, and you can profit on it more often than you lose. And you're going to be able to obviously get bigger profits out of those winning trades because you're going to be catching the biggest and the best trends that are going to run further and faster and longer, which is again another thing that puts even more profit into your account. And I think I've touched on this earlier, this is probably the most important point, you will significantly reduce your losing streaks and your drawdowns because you will actively steer clear of those choppy ranging, low quality markets. which means unnecessary excessive losses are going to be a thing of the past. Now, you are never going to eradicate losses. They are part of trading. You've got to get used to them, but you can certainly reduce them and you can avoid the unnecessary losses. And that will make you feel very smug, knowing that you have now got the skill to sit on the sidelines while other, perhaps less informed traders are still blindly getting chopped up in sideways moves and blowing their accounts because they don't actually know what's going on. Remember, trading is a zero-sum game where the losing traders in the crowd fund the luxury lifestyle of the winners. So if you are going to trade in any market, there are only two outcomes. Either you win and make money, or you lose and you give your money to the winners. And no one is going to willingly choose to be a loser. So doesn't it make sense to equip yourself with the best advantage possible to give yourself the best chance of success? Now, we've got 10 minutes left, so I can finish at the top of the hour. So what I'd like to do now is bring up a live dashboard. So that on your screen now is a live dashboard. Hopefully you'll see this processing bar in the bottom. This is updating now. This is looking at the New York session. So this left-hand box is looking at the New York market. So right over here on the left-hand side was 8 a.m. New York time, so an hour before we started here at MarketFest. And this pink line at the top is the euro, and this blue line at the bottom is the US dollar. We also have the yen over here. There's been a little bit of news. You can probably see some spikes here. Let me see if I can bring up a chart and have a look at the euro US dollar. Let me just drag the euro US dollar onto this chart. This is a 5-minute chart, by the way, that I'm looking at. Let me find the market open. So the market open was on this price bar. Hopefully you can see my mouse cursor. I'm not sure if go to webinar lets you see my mouse, but it's more or less in the middle of the chart. That's where New York got started. You can see not an awful lot happening on the euro US dollar prior to the New York session, not much happening in the London session, and then all of a sudden it takes off and you've got a great trade. Now, it's a coincidence that today the euro against the US dollar is the best currency pair to be involved in. It is the most popular of the currency pairs, but more often than not, it's actually one of the quieter pairs. Not an awful lot happens in the euro US dollar. The big moves happen elsewhere. And by looking at the real market, looking at this individual data down here, you're going to see that. You're going to get a much better idea of what is actually happening. Some days, yes, it'll be the euro US dollar that you want to be involved in. Other days, it's going to be the pound against the yen. Other days, it may be the US dollar against the Canadian dollar or the US dollar against the Swiss franc. It does change from day to day because banks change their agenda from one day to the next as they're executing big orders either for themselves or on behalf of clients. And you can just chase after it. You can look at this. So the way I've got this set up, let me just get rid of that chart a second. The way I've got this set up is the left-hand box lets me look at the session. So this is looking at New York start. The middle box, I've got this set to look at the last 1 hour. You can see probably that it says rolling 3,600, that's seconds. So this is set to look at the last 1 hour on a rolling basis. And the right-hand box, 600 seconds, that's 10 minutes. So that's the way I have it set up. So I've got the session, the last 1 hour, the last 10 minutes. If we go into the settings box, however, you can see we can change these settings down here to any time frame we want, including long-term historical. If I want to set this to look at the last week or the last month or the last year, I can. We can look at different market sessions for their liquidity. So I've currently got this set to look at the New York morning session liquidity. Anything in green tells us that we are currently above average liquidity for the New York session this time of day. Anything in red says you're slightly below average. So I keep an eye on that. If this is predominantly red, I don't trade. It's not worth trading when the liquidity is low. When the liquidity is high, it means there's lots of people active in the market, lots of people engaging in trades, and you've got much higher probability for trends. Now, there is actually a high impact piece of news that is coming out in less than 10 minutes, but I will need to be finished by then. If we were watching this in real time, as that news hits, you will see instantly which currency pairs or which currencies have been most affected. You'll be able to look at the tick volume indicator in the middle and tell us where market makers are concentrating their orders and in which direction. And although I can't show you on this chart, because the chart that I've got here for the presentation is a floating chart, but I've actually been able to detach from my platform. What I would normally have on here at the bottom is the volume indicator. So that would show us what the market makers are doing on there. Dale, I can just see that you've said that we're looking at the Euro New Zealand. It's not. I know it says Euro New Zealand in the top, but just underneath on the actual chart, it says Euro US dollar. That's one of the other things about these floating charts. Let me change it again. I'll change it to the pound US dollar, and you'll notice that the chart changes to pound US dollar, but the title in the window remains Euro New Zealand dollar. That's why I can't put the bid and the offer indicator on here either. The floating charts are a little bit unusual. So that's what we've got with that dashboard. I can see your comments box. We've got a couple of minutes to just go through some questions if you want. I do want to make sure that we are finished at the top of the hour so that we don't delay the next speaker. Hopefully I've caught up a little bit of time. But any questions you've got about this, please let's use the next, say, 3 or 4 minutes to go through them, and I'll answer them as best as I can. I'll just see if I can scroll back in case any have come out while I was presenting. I wasn't looking at the chat box while I was presenting because it would distract me. So I'll see if there's anything in there. If there's not, if you've got a question, just type it into the chat box and we will quickly run through it. Jenny, I've answered that question, I hope, about what the rolling 3600 and rolling 600 is the last 1 hour and the last 10 minutes. As I said, you can change that to anything you want. Yes, we'd look at news, definitely. One of the good things with the bid and the offer indicator and looking at volumes, we can actually see when the news hits which pairs are likely to take off. When news hits, it hits everything all at once, but usually the real orders only go in on certain pairs, and that's what you've got to look for. So you'll see a big spike hit the market, the entire market moves, and then the real orders start going into the market. Now, while we've got, okay, Don, let me just quickly see what time frame does this work on best. You can apply it to anything. I personally trade on 5-minute charts. I'm an intraday trader, and I do find that intraday trading tends to be a little bit better. It's a little bit more predictive. Longer term, I don't think it's got quite the same edge, but you can set it to anything that you want. Now, in the last 5 minutes, because there's a couple of questions about the software and buying it and what the costs are, etc. So let me quickly run you through the offer that I said we had. There is a bonus package for you exclusively for today's MarketFest event. So you are going to get the full advanced analysis dashboard. You'll get the bid and the offer indicator that I showed you that attaches to your charts. And there's actually also a number of other automated one-click order buttons and trade management tools included in that. And on top of that, you also get a detailed trading course to teach you what you need to know, including teaching you a system. Now, the trading course normally sells for $99. You'll see it on my site. The dashboard, we sell it separately on a monthly subscription of $199. You're getting it all technically for free today. We've combined it all together, structured it as a challenge for you. So you'll get the trading course, which is all online video based. It's about 7 hours of video. That will teach you more about Forex than we've had a chance to cover today, but plus it also has detailed tutorials on how to use that analysis dashboard, and it will also explain a simple system for using that dashboard to make high probability trades. Now, the course will take 1 week to complete, all of the lessons and the training, and then we'll have a 4-week trading challenge to put it all to work and see if it actually makes profits for you. And this is where the wager comes in. I want you to follow the instructions in the course for 1 month. If your account hasn't grown in that time, then I will pay you $10. If it has, then you pay me $10. So that's the wager. Now, obviously, my hope is that by letting you use all of this up front, if you get the training, you get the education, you use the tools, and you experience them all firsthand, no risk, then you're going to be able to see for yourself how effective and reliable it is. And then I'm hoping you'll choose to sign up properly with us, and you will actually pay for some of our products after you've seen for yourself that they do work and they are really worth it. So I've clearly got an ulterior motive for doing this, but hopefully you can agree that it is a very fair and transparent way of doing it. You give it a try, prove whether it's any good or not, get some results, and then you can make the decision whether you want to get more from us or just walk away. You might love it, you might hate it, but there's absolutely no risk or obligation on your part. You literally can't lose. You've got it for over a month for free and put me to the test. So all you've got to do now is use that link that is on the screen to register for that. I'm not sure. Let me see if I can post a clickable link to you. I should be able to. If you look in your
James,
chat
I
box.
posted the
Okay,
the link to
thank
them,
you.
and yeah, but you can't. It's not clickable. They just have to copy paste it, or just jot it down and type it out.
Yeah.
But it's a pretty simple link. So anyway, I posted it for you.
Perfect. Well, you've got those details. You can sign up. Like I said, it's completely risk-free. Before I sign off, just note there is a couple of questions here. Are you signing up to any subscription or anything like that? No, you're not. There's no recurring billing or subscriptions or anything like that. This is a one-off. If you decide that Complete Currency Trade is the best thing you've ever come across, you will actually have to be proactive and take steps to sign up with us at the end of the challenge. You won't be automatically enrolled in anything, and that way, if you decide that this isn't for you and you absolutely hate us, you don't have to remember to cancel anything. There's nothing to cancel, so you don't have to give us a second thought at all. So hopefully that is worth it. Please take a note of that link. Yes, you do need to put your $10 down up front, because it would be impossible for me to chase several hundred people at the end of the 4-week challenge saying you owe me $10. You put your $10 for this wager up. If you don't make money at the end of the 4 weeks, I'll return that $10 to you, and then I will send you an additional $10, which is me paying you as part of that wager. So hopefully a fair deal for you. Hopefully you've enjoyed that presentation and we've managed to finish on time. If you have got any questions, please wait to the end of the MarketFest event today, and you can either contact Jeanette and she'll forward any questions on to you, or you can come over to the website and contact us a little bit later on today if you've got any questions. But thank you very much for your time today.